Very few people really understand what is about to happen with this economy. I think that some people are starting to feel it, starting to recognize it, but it's going to be much worse than a lot of people probably understand yet. But I guess we all get to see it play out in front of our very eyes going forward, unfortunately. Hello, everybody. There's a few things I want to talk about today with you. One of them is the subtle changes in the employment picture, which is going to be telling about where we're heading. Also, I want to mention a few of the first things, just because I haven't done this in such a long time, a few of the first things that I look at, and I think that everyone should look at when they're interested in potentially gauging the value of a company, or if they want to invest in it, or even if you already own it and you decide if you want to sell it. A few of the first things that I look at, which are freely available, very simple. I'll show you exactly how to do it. Plus, we're going to talk about a lot of the demand trends in gold, which are really picking up. You're seeing a lot of strength in gold lately. So I want to get into that. It's going to be a good video. Let's do this.
At Peter Leeds, we are all about getting you profits quickly and easily. Please subscribe for more premium investor enlightenment.
And the huge and rare Peter Leeds sale has officially come to an end. I want to congratulate everyone who got involved with the newsletter or the Academy course or the trading chart course at a discount. You guys are soon going to see the benefits and changes that investing well can bring into your life. And I realize it's been a while since I've talked about this, so I wanted to mention a few things. It's really simple, and anybody who's interested in looking into a stock or looking into an investment that you're prospectively going to buy, perhaps one you have that you want to sell, I'm going to show you exactly how to do it. It's so simple. It doesn't cost a penny. It's really quick. I'll share my screen with you so you can see what I'm doing. There's plenty of different places where you can get this information, whether it's charts or financial information, all free sites. You choose whichever one you want to use. I'll just tell you a few. If you don't know one, I'll give you one that's really simple. I always say, and this is what I told my son the other day, I always say, start with something simple like bigcharts.com. Go there, you put in your ticker for the stock you want to look at. So you put IBM in the ticker symbol box and pull up the chart. My charts will look different on screen than yours because I've set them up differently because I'm using the Japanese candlestick trading charts, which tell you so much about the psychology of investors. And you guys need to use candlestick trading charts because you can understand when a trend is going one way, when it's more likely, more probability to change and start going the other direction, whether it's going from down to up or from up to down. The psychology of investors will tell you when that shift is happening, when that shift is taking place, so you know how to position yourself before the stock moves. But we're talking about fundamentals in this part. So pick a stock or think of a stock that you want to look into. So we'll put, just for ease, I'll put Newmont Mining. And again, your chart's going to look different than mine, but don't worry about it. Here you'll see a little thing that says profile. You click on that, it'll take you to another site that you can get access to the financials. The financial reports that publicly traded companies are required to put out to investors. That's part of the investor visibility aspect of being on a stock market. And I go first, before anything, to the balance sheet. And on the balance sheet, I don't look at the annuals, I look at the quarterlies because the balance sheet is a snapshot. So you want the most recent financial report to show you where the company's at. And all you're doing is you're looking at what does the company own versus what do they owe. Other people will call it assets versus liabilities. So you look at your total assets on the quarterly balance sheet and compare that to the total liabilities, what the company owns versus what the company owes. You want to know that they own more than they owe. If someone has $5 million in assets, but they've got $10 million in liabilities, there's nothing compelling about investing in that situation whatsoever. So I want to know if a stock is worth my time even looking into it more deeply. So I want to see first, are they solvent? Do they have anything going on? Do they have some kind of assets above and beyond what they owe in banks and mortgages and rent and other liabilities, all sorts of expenses that have to go out. Take a quick look at the total assets versus total liabilities, current assets versus current liabilities. The difference is current means things that are active or relevant within the next year. If you own a massive factory, you don't cash that out anytime you need to raise money. That is on the books for many, many years. So you sit it in the total assets, long-term assets, but you don't put it in the short-term assets. It's that simple. Next, I go to the income statement. And these you can look at annuals and quarterlies because what you're looking for is trends and growth. So you want to see from one year to the next, to the next, to the next, are they generating more sales on the income statement? And on quarterly periods too, from one 3-month period to the next 3-month period, are they generally generating more revenues from one period to the next? You watch for that trend and you watch and see if that trend is accelerating. And you'll need a mix of looking at the quarterly results and the annual results to see, because the more of a view you get, the more information you have. You want to look at 5 years and you see over 5 years, are they generally getting better and better and better? And the time to invest in a company is when they're going from losing money to losing a little bit less money to losing a very little bit of money to then turning a profit and then making more profit, more profit. As that transition happens, that's where the stock has the biggest reaction in price. And it's not once they start making a profit, it's when they start getting the ongoing loss down and down and down until it almost disappears. That's the time to strike. And then as they turn the corner, if they keep the trends going, then they start making a profit. That's when you're going to get the most benefit or the most increase in a short window of time in the share price. What you're looking for on the income statement is net earnings. You want to see a company is making a profit. They're doing all this stuff, and at the end of the day, have they lost money? That's not a good investment. You want a company that has the capacity, the potential to make a lot more money. And as they do that, the share price will benefit, shareholders will benefit. And understand that this is a very cursory look at the way I do things, as the way anyone should do things, but this is a very good starting point. Make sure that they've got more assets than liabilities. They own more than they owe. And then you look at the trends in the income statement. You look at the trends of revenues and sales. Are they selling more? Are they selling more? And is that translating into lower and lower costs and eventually net earnings? That's the main one you want to see. You want to see a company that's doing all of the activities they're doing, and at the end of the day, they've actually generated some money. And I want to talk about gold because it just hit a 6-month high in price, and since then it's gone up even more. It hasn't quite yet hit the all-time high, but that will be next. That's about $2,055, I think, give or take. But it's irrelevant. Gold has already hit all-time highs in every other country, every other currency, except for the US dollar. And a big part of that is because of the strength of the US dollar that we've seen recently, which is now starting to turn the corner, starting to go the other way. US dollar is starting to come down as I expected and as I told you would happen. That's reflected in an increase in the price of gold. This is an article from Jenny Reed. I got it from CNBC. Goldman says China is returning for gold as investors ramp up bets on rate cuts. Again, as I explained to you, as the Federal Reserve pivots and stops raising rates, they held steady and they're starting to possibly lower rates. That's going to be not good for the dollar and by extension, pretty good for gold prices. And keep in mind, it's all about expectations. When people generally feel like or expect that the Federal Reserve will lower interest rates, they act generally then. You don't want to wait till they actually start lowering rates. You want to know that they're going to lower rates. Position yourself ahead of time so that when they do actually get closer to lowering rates, that's when all the benefit happens with the investment. And this article from Jenny Reed goes on to talk about the CME's FedWatch tool showing a 25% probability of a rate cut as soon as March. And most investors are now expecting 2 or 3 rate cuts going into 2024, all of which will be very bullish for gold prices, not good for the dollar. And this is from the World Gold Council. On a year-to-date basis, central banks have bought an astonishing net 800 tons of gold. Net being, you take off the gold tons that they sold, you add up the gold tons that they bought, and at the end of the day, it's 800 tons of net gold purchases, which is 14% higher than the same period last year. So not only are the central banks buying more and more gold, they're buying more and more gold at a faster rate. And when all of these factors that have been leading up to the bullish trends pushing gold prices higher, when they all come together and gold prices go, if you're not already involved in this trade, you're going to be too late. You're going to say, oh, I missed the boat because gold spiked $50, $100. And you don't want to be that person. You want to be the person who got involved now before it does those spikes. That's where all the gains are going to be made. And you guys will see that I'm back in Detroit. For the holidays I was here. You have to be in Detroit for Thanksgiving. Everybody does. And then I'm bouncing back to the studio in Toronto, and I'll be between Detroit and Toronto, as always, bouncing back and forth. I can't tell you the schedule ahead of time, but it'll be always me giving you the videos, the information I believe you need to know at the time. And I'm just going to keep on doing that from whatever location I'm at. This is an article from Eric Rosenbaum, a signal for big companies. They think the workers are losing control of the job market. These are one of the subtle indicators about how the employment picture is sort of shifting subtly and gradually, and it's going to tell you something. Let's get into this. There's been a sharp increase among top corporate executives saying it has become easier to find and hire qualified workers. That's among one of the many signals in the fourth quarter from CNBC CFO Council survey that reinforces the view among chief financial officers that the peak inflation era is over, and also that the economy is slowing. Keep in mind that this is just opinions of CFOs. It's not fact. But the fact that they're finding it easier to find workers says a lot. The employment picture is like a lumbering beast, and it will take such a long time to transition into a more employer-friendly environment. There weren't enough workers. Things are starting to change. It'll make it easier for companies to operate. But the CFOs are showing an opinion that the peak inflation era is over, and that depends. I do believe a lot of it will be based on the actions of the Federal Reserve. If we get into more monetary creation, then that will be more inflation. You don't see it at the same time always either. When there's a big bouts of quantitative easing, 1, 2, 3, 4, not quantitative easing infinity, all of that, inflation didn't kick in. So we thought, oh, okay, so we could have just made free money and no inflation, no downside. But it gets there eventually. This takes longer. People don't realize how long it takes. And that's why, depending on what the Federal Reserve and even the Treasury Department does, is going to really be telling for where inflation is going to go. And I believe that we've had the big inflationary bounce, and I do believe that it's going to be incredibly difficult for them to slow inflation without driving the economy into a recession. It goes on to say that more CFOs have come into the soft landing camp rather than predicting a recession for 2024. It's their opinion. I don't think they're correct. You know that if you've been around on this channel. I believe that we've set up all the ingredients for what's going to be a recipe for an absolute significant recession. I'm planning for that. I'm planning for the worst. I'm hoping for the best. There's so much financial manipulation going on. They're controlling things so much that, yeah, they're going to try their best to get us out of what should be a pretty serious recession. They'll do some things to help that not happen. But if history is any guide, there's all of these things that individuals in the powers that be think they can do to control things when they don't really actually have any control whatsoever, as is demonstrated by every recession, depression, stock market collapse in history. And now here we find ourselves with an unpayable debt load, an economy that is either going to go into a recession now or in the future. But it will be here. And when that happens, all the rules change. The things that politicians told you they were going to do will change. There will be a different collection of strains on things like businesses, on workers, on the labor market, on the operations of companies. I don't see a path out of the situation that we've economically set ourselves up for. My most likely scenario opinion is that the economy gets pretty bad, and the Federal Reserve responds to that by lowering interest rates pretty aggressively. And at some point in all of this, everybody's going to forget about inflation. It's going to get away from us, and then we're going to be in a much more untenable situation. Either way, just make sure to prepare yourself to get set up, established, that you take care of yourself and the people you care about. That's why it's so important now, and why I'm so proud of all you guys who are getting into the Peter Leeds Academy, the trading chart course. You're going to learn ways to survive in any environment. Even though the stock market's doing poorly, there's going to be a lot of opportunities in there. And that's a lot of what the trading chart course can show you, and the Academy, of course, shows you that as well. Very few people really understand what is about to happen with this economy. I think that some people are starting to feel it, starting to recognize it, but it's going to be much worse than a lot of people probably understand yet, but I guess we all get to see it play out in front of our very eyes going forward, unfortunately. And in case I don't say it enough, please subscribe to the channel. We do want to build a following. We do want to get our message out there. And a lot of the promotion that the YouTube algorithm is going to give to our channel will be based on the actions that you guys take. The more you're into these videos, the more you watch them towards the end, the more you share them or click like, the better it is to get our message out to the people. And there are a lot of them right now. The people need to hear this.
At Peter Leeds, we are all about getting you profits quickly and easily. Please subscribe for more premium investor enlightenment.